So we are going to do a walkthrough of a full inheritance tax computation, thinking about the three different stages that we could be asked questions on. We're looking at somebody who is making transfers during their lifetime. So we'll think about lifetime tax on lifetime transfers. We're going to look at what happens when they die, and we have to go back and recalculate tax on transfers made in the 7 years leading up to their death. So death tax on lifetime transfers. And then we're going to look at the third element of inheritance tax computations, which is death tax on the death estate. So this is a brilliant question for us to walk through together, because you're going to see all three of those stages in this question, and it's going to help you see the big picture for an inheritance tax computation. You're probably not going to be examined on something of this length in your exam, but if you can understand the full process from beginning to end, it means you can jump into whatever the scenario is in your exam, and you will be able to understand what's happening, and you won't waste time dithering about doing other bits and pieces that are really not necessary. So this is a great question, and I'm going to run through each of those three stages with you. So let's have a read through quickly of the question to get the gist of what's happening here. We've got Matteo nearing the end of his life, and we're told what he's got in his estate at the moment. So this is his wealth. This is the values of the items he owns, and if he were to die on today, this is the value of each of the items he owns. So he's got some shares, he's got deposits in an ISA, he's got a main residence, and he's also got a property that he rents out. So as you're looking down those items, you should be thinking about certain reliefs that might apply, any exemptions that can apply here, every time you're looking at an item that you're given in the question. So if we think about shares, you might be thinking, will business property relief apply to this? Look at the holding, 4%, no. It's less than a 50% holding in a quoted company, therefore they don't have control, it's not going to qualify for business property relief. ISA deposits. Are ISAs exempt for inheritance tax purposes? They are for income tax, they are for capital gains tax, not for inheritance tax though. What about main residence? What relief should you be thinking about there? Residence nil rate band. That should be popping into your head as soon as you see a main residence. And what about a rental property? Anything about that? No, no special reliefs about that in inheritance tax. We're told that he's going to leave all of these assets to his son in his will. What's significant about leaving the items to his son? Residence nil rate band. Direct descendant. Son is a direct descendant, residence nil rate band. So as you're doing your read through, you should be thinking about all these things at once. You might not know the answer straight away, but these are the types of things that should be popping into your mind as you're looking at each type of asset. Then we're told a number of things that he gave away during his lifetime. We've got dates, and we've got the amounts, and we're told who they were given to. So we've got a gift of £203,000 into a trust. What is it when we put a gift to a trust? What do we call it? We call it a chargeable lifetime transfer. It's not a PET. It's not a potentially exempt transfer. It's a chargeable lifetime transfer. Anything left to a trust is a chargeable lifetime transfer for your exams. And therefore anything else is going to be a PET. This isn't. This is a CLT. And that means that there may well be some tax to pay during lifetime. We're told the trust paid any inheritance tax on that gift. So who's the trust? Is the trust the donor or the donee in this situation? They are the donee, the party that is receiving the gift. And if it is the donee that is paying the tax, well, what tax rate would they be paying during lifetime, during the donor's lifetime? What tax rate would we use if the donee is paying the tax? We use 20. Okay, so it rhymes. Donny 20. Okay, that's how to remember it. 1st of October 2019, we've got a gift to the son, £150,000 as a wedding gift. What are you thinking when you see that they're giving some money to the son as a wedding gift? Any exemptions that apply there? Yes, we've got a marriage exemption, don't we? So that's one we want to consider when we're doing our calculation. What about the gift to the granddaughter? £200. Quite a small amount, isn't it? Is there any particular exemption that is jumping into your mind about this? What about small gifts? There's a small gifts exemption in inheritance tax. Does this fall into it? So we've got 3 transfers made during his lifetime. We've also got assets that he will own when he dies. And we're being asked to work out the inheritance tax liabilities if he were to die on the 31st of December 2023. And we're told to state relevant due dates of payment as well. Now we're given nil rate bands for earlier years, and you're always going to be given this if there's something from a previous year. So it's been 325,000 for a long time. But in the exam, they're only expecting you to know what the rates and thresholds are for one particular year, unless in the tax tables they give you an earlier year. So because they don't give you the nil rate bands for previous years, and if we go back a bit further than this, if we go back to previous years to the ones we've got here, it actually was different. It's just been 325,000 for a long time now. So they will give you those figures. Okay, but if they don't, you would assume that the current year's rates and thresholds apply to earlier years and later years. You're not expected to know what all the different rates and thresholds have been or are going to be in the future. So with that in mind then, we want to start thinking about how to approach this question. Remember I said there's 3 main stages with inheritance tax computations. We have lifetime tax on lifetime transfers, we've got death tax on lifetime transfers, and we've got death tax on a death estate. And this question is going to let us look at all 3 of those things. Inheritance tax is a very methodical tax. We work chronologically and we work from the donor's point of view. So we're going to work chronologically. So what is the first thing that would have happened? It would have been Matteo giving the transfers while he's still alive. So we're not worrying about his death estate and the assets he still owns. We're going to look at the things he's given away during his lifetime. And because we're working chronologically, we're going to start with the 1st of November 2012 gift first of all, and work our way up to the one on the 1st of February 2021. Okay, so the first thing we're going to look at is lifetime tax on lifetime transfers. And we were given 3 transfers that were made during his lifetime, and we're going to deal with them in chronological order, as we said. So we're going to look at the gift to the trust first, which was back in 2012, the gift to the son in 2019, and the gift to the granddaughter in 2021. Using a column approach is really helpful because it saves you repeating the same pro forma over and over again. Now you probably will find that if you're doing one of these calculations, you're not necessarily going to have exactly the same things happening under each of the gifts, but you might find it really helps you in the exam to go in with a sort of pro forma in mind of what a calculation would look like, and then you're just trying to fill in the blanks with each of the transfers. And if you put them in a column form, it will save you time. So we're going to start chronologically, and we're starting off with transfer number 1, which is the gift to the trust on the 1st of November 2012. That was a CLT, we said, because it was a transfer into a trust. First thing we need to put in is the actual transfer value. So what is the amount that was actually given? It was £203,000. And then we start thinking about exemptions. Now you know that there's an annual exemption that you can apply each tax year, But before you apply the annual exemption, you want to think about other exemptions that might apply. Now, a CLT, nothing in particular there. It's quite a high value amount. It's into a trust. Therefore, there is no particular exemption to deduct from that one, and we can move on to our annual exemptions. But what I'm going to do is I'm going to leave a little bit of a space in my answer, because if there are exemptions for any of these other two gifts we've made, it will go before the annual exemption is applied. So I'm just going to leave a little bit of space. So annual exemptions then, it's £3,000 and it's set off against the first transfer that happens in a tax year, whether it be a CLT or a PET, doesn't matter. Now in this tax year we're looking at here, which is tax year 2012-2013, we have only been given information about this CLT, so it's going to get the annual exemption that would apply in that year. And because there's no transfer that's been made in the previous tax year to when this one was made, we can also deduct the prior year's annual exemption, but do current year first and then anything left from the prior year, and it's only the one prior year you can carry forward. So that's £6,000 we can take away from the transfer of value of that CLT, and that gives us a gross value for it of £197,000. What would you do next? You've got this value now after exemptions of £197,000. Can you reduce that value even more before you work out the tax on it? Yes, so this is the stage where we start thinking about our nil rate band. And at the date of the gift, we were given that information in the question. It was the £325,000 amount. From that 325, we are going to deduct any gross chargeable transfers in the previous 7 years. Now that's 7 actual years. So where we have got the 1st of November 2012, when this transfer into the trust happened, we're going to go back 7 years before that date. So we're going back to the 1st of November 2005, and we would look in that 7-year window and we would see if there was any other transfers made during that period. Now there weren't. There was nothing else made during that time period that would use up the nil rate band, and so we're looking for any other CLTs that were made in the previous 7 years, because those are chargeable transfers. PETs are not chargeable transfers while the donor is still alive, so they wouldn't, if there had been any PETs made in those 7 years, then they wouldn't eat away at the nil rate band. It would only be CLTs made in the previous 7 years that would. I've changed this label here just to say chargeable value, because we talk about gross chargeable transfers here in eating away at the nil rate band, and what that means is if you had had a CLT where some tax was due on it in the previous 7 years and the donor had agreed to pay the tax on it, then the gross part of it actually comes from the fact that you would have the value of the transfer plus any tax that the donor had paid on that CLT. So it would be that figure you'd be deducting here. Now we don't have this in this particular example, but that's just a complication you might see in other examples that you're looking at. So we are saying that we're getting a full nil rate band of 3 to 5 that we can set off against this particular CLT then. So that's good from the, well, it's the trust that's paying any inheritance tax if there was any arising on this gift. So no tax is actually going to therefore be due, which you can see that I've put there at the bottom. Now remember, you're doing this in a column format, so some of the other gifts that you look at might have some tax payable, so that's why we've put in the taxable amount figure, 0, and the inheritance tax payable label there as well. Now I've put at the bottom of this column, gross chargeable transfer value £197,000. Now there was no tax to pay here, and it wasn't getting added on to the transfer value because the donor wasn't paying it even if there had been some tax. But that 197 figure, why that's there at the bottom, is because you're going to need that figure in the future for other calculations that you do on later gifts perhaps. So just getting into that habit of finishing off at the bottom of the column this gross chargeable amount figure to carry forward and use in any future calculations really is a great habit to get into. Stops you making mistakes later on picking up the wrong figures. Then we move on to the next thing that happens chronologically. On the 1st of October 2019, he gives his son 150,000 as a wedding gift. So we're going to move on to that column now. Let's make this a bit bigger so we can focus on the numbers. Now, remember I said that before you apply any annual exemptions, you should be thinking about other exemptions that might apply to a transfer. And here we have this gift on the occasion of the son's marriage. And because it's coming from a parent to a child on occasion of that child's marriage, we can make the first £5,000 of that gift exempt. So that's the marriage exemption from a parent to a child. So we take that 5,000 away and then we deal with our annual exemptions, which again, so now what tax year are we looking at here? The gift was made in October 2019, so that is tax year 1920. So we've not got any other gifts made in that tax year. This is the first and only one. So we get the full 3,000 of the current year's annual exemption to set off against it, and we also get the prior year, 1819's annual exemption as well. So take away those two amounts and we get down to a chargeable value figure of £139,000. Now remember, what are we working out in this particular case? We are looking at lifetime tax on lifetime transfers. The donor is still alive. Therefore, this gift to the son is a pet and there will be no tax on it. And there is no looking at the nil rate band. So we stop at this point here. The chargeable value point is where we stop. And that figure of 139,000 becomes the figure that we would use in any future calculations. That becomes our gross chargeable transfer value. We do not allocate any nil rate band because the donor is still alive. The nil rate band is only when we're actually looking at potentially taxing something, as in with a CLT. There could be tax to pay on that during the donor's lifetime. There will not be. With a pet, the potentially exempt part of it is if the donor dies within 7 years of making that gift. That's where there's potentially tax. A CLT, there is tax to pay unless you've got enough nil rate band to cover the value, which we did in that first instance. So for our pet that we're making in October 2019, we are just going down to this 139,000 value. We still apply the annual exemptions even though there's not going to be any tax payable at this point in time, but the annual exemptions still apply against transfers regardless of whether they are pets or CLTs. And then what was the third item? It was £200 gifted to a granddaughter. So is there any exemption that could apply to that? Before we think about annual exemptions or anything like that, is there any specific exemption that could apply to this type of transfer? Yes, the small gifts exemption can apply here because that allows us to gift up to £250 in a tax year to one particular person, as many people as you like, but one recipient of each £250. So this granddaughter got £200, so that's covered by this small gifts exemption. Therefore, we're not going to have to worry about applying any annual exemptions because there's nothing left to apply that to, so they're not getting used up there. And our chargeable value is 0 for any future calculations on that one. Okay, so that is us. We have dealt with the first stage of inheritance tax, which is looking at lifetime tax on lifetime gifts. The donor is still alive at this point. So we've actually not had to pay any tax as yet. The next stage is the donor dies. And then we have to go back and look at all of the transfers they made in the 7 years that leads up to their death. Okay, and that includes CLTs and pets. Any transfers they made in the 7-year window before their death. So we were told to assume that Matteo is going to die on the 31st of December 2023 in this example. So what time period are we caring about here? We're wanting to work out the death tax on lifetime transfers. What time period are we looking for transfers? If he dies on the 31st of December 2023, we're going to be looking at the 7 years from the 31st of December 2016 up to the 31st of December 2023. That's our 7 years. So it's 7 calendar years. It's not 7 tax years, it's 7 calendar years. So we're looking at that time frame then. So our first date that we would be checking is the 31st of December 2016. So do you see that CLT, the gift to the trust, that falls outside of that 7-year window? It was not made in the 7 years prior to Matteo's death. And what that means for us is that we're not going to recalculate the tax calculation that we did previously. There is no need. If there had been some tax payable during the donor's lifetime on that gift to the trust, we wouldn't be adding any more to it. So the CLT falls outside of our 7-year window. But it is important because it has an impact on later gifts. We're not recalculating that gift to the trust, but that 197 figure is going to have an impact on what we do when we're looking at the pets that do fall within the 7 years, because you can see October 2019, February 2021, those two gifts definitely fall within the 7-year window leading up to Matteo's death. Okay, so the 197 figure is not forgotten. We will be coming back to look at that, but we're not going to recalculate this one here for the CLT. So with nothing further to do with that CLT, we can move on to look at the things that do fall within the 7 years before Matteo's death. Chronologically again, so we're going to start with the gift to the son first of all, and we're going to pick up the chargeable value. Now, when we were doing the lifetime calculation, we didn't have to apply any nil rate band or go that far because it was a pet. So we can take the 139 figure, and that's where we're going to start now, because now it's called a failed pet. It now becomes chargeable because the donor has died within 7 years of giving the gift. And therefore we are going to recalculate this one. And so we go through a similar process that we did for our CLT during lifetime, and we look and see whether there is nil rate band available to use against this value in order to reduce it. So yes, there is. The nil rate band operates on a 7-year rolling basis. So every time you're looking to see whether the nil rate band is available against a particular gift, you're having to look at the 7 years leading up to the date of that gift and seeing if there was anything else that happened in that 7 years that would have used up the nil rate band. So the nil rate band that applied in tax year 1920, because that's where we are with the gift to the son, was 325,000. And that's going to be reduced by any chargeable transfers made in the prior 7 years. And we know there was one. Remember we had the CLT, remember we had this value of 197,000. That figure is the figure that is going to impact now on this pet. It's not that we're going back and calculating any more tax on that CLT, because we're not. It falls more than 7 years before death, but it does have an impact on the amount of nil rate band that's available to use against this gift. Why? Because the 1st of November 2012 falls within 7 years of the 1st of October 2019. There's not much in it, but it is within 7 years. And therefore, rather than it being 325,000 that's available to use there, it's going to be reduced by 197,000. So actually, we're only going to have an amount of 128,000 that can be used as the nil rate band against that 139,000 value. And I've just created a little bit more space there just to show you the reduction of the nil rate band, and the fact then that that leaves us with 128,000 to deduct of nil rate band that's available to use against this gift to the son in 2019. The taxable amount then of that pet, because the donor didn't survive the 7 years, is £11,000. And then we go on and work out the tax due on that. So death tax rate is 40%. So that's what we're going to use for this. So that's £4,400. And then, because the donor has died, because we're going back and recalculating transfers that were made in the 7 years leading up to their death, taper relief can apply. Taper relief does not apply while the donor is still alive, and taper relief does not apply in a death estate. So this here, where we're doing death tax on lifetime transfers, is the only place you're going to see taper relief potentially apply. And it doesn't apply in all situations. It's only for when the donor has survived 3 years since the date of the gift. So if they've survived 3 years, but they haven't quite made it to the 7 years, there is an amount of relief we can deduct. And use your tax tables. The information is in your tax tables. You do not need to memorise this. What you do need to look at is how long did they survive after the date of the gift. So the date of the gift was the 1st of October 2019. They died the 31st of December 2023. What is the time difference between those two events? It's between 4 and 5 years. We do not prorate this. We just go, what number of years is it between? Is it between 3 and 4, 4 and 5, 5 and 6, 6 and 7? Here it's between 4 and 5, and therefore you get a 40% reduction on tax. So 40% of the tax is 1760. So we're getting to deduct 1760. Because they didn't quite survive the 7 years, but they survived a good number of years. So the closer you get to the 7 years surviving, giving the gift, the more relief you get and the closer you get to it, this pet becoming completely tax-free. Now it's not, because he did die within 7 years, but he made it between 4 and 5 years. So he does get some, or they do get some tax relief. Now there was no inheritance tax paid during lifetime on this gift because it was a pet. If this had been a CLT we were recalculating, then you would deduct lifetime tax at this point, but there isn't any because it was a pet. And that therefore brings us down to the inheritance tax being payable due to the death of the donor on this one being 2460. And so we were asked to do the due date of payment as well. So where we've got a pet that becomes chargeable as a result of death, which is what we've got here, the due date for payment is 6 months after the end of the month of death. Now, in this case, Matteo died on the 31st of December, so died at the end of a month, and then you're going 6 months on from that. This is a common mistake people make, is that say he had actually died on the 15th of December instead, a lot of people would then say that the payment would be due the 15th of June in the next year. And that's not the case. It is 6 months after the end of the month of the death. So regardless of what date during the month of December he had died, the payment date would have been the same. It would have been the 30th of June 24. So we can move on to the last transaction that happened in the 7 years before his death, gift to the granddaughter. It had no chargeable value, and that doesn't change. Just because he died within 7 years, the same exemption, the same small gifts exemption applies. We don't recalculate that. We've already done that work when we were doing the lifetime tax calculation. So there is no tax to worry about now just because he has died, because the same exemptions apply on the recalculation. So there's nothing extra to do there. So we can just fill in 0 for that as well. Okay, so that is us. We've done death tax on the lifetime transfers now. And the third component then is looking at the death estate itself. So what did we have in the estate? We had shares, we had an ISA, we had a main residence and a rental property. So your first step is going to be actually pulling together the things that are taxable. So the shares, there's no BPR that's going to apply to those. The ISA, yep, they're taxable. They're not for income tax or CGT purposes, but they are for inheritance tax purposes. Now, the main residence is one we're going to come to and look and see if we can do anything with. The rental property, nope, there's nothing we can do with that one. But the main residence, because it was left to a direct descendant, we can reduce the value that's going to be in the estate and getting taxed. So we can reduce it by the residence nil rate band, which is 175,000. The value of the main residence is higher than 175, so we can apply the full 175,000 for that. And then the other one we want to think about is the nil rate band itself. Because again, there's a nil rate band that you can use against the death estate, but again, it's a 7-year rolling nil rate band. And so we have to look at what's happened in the 7 years leading up to this date of death. Has anything happened in that 7 years that would use up the nil rate band that's available to set against the death estate? And what were the things that fell in that 7-year period? It was the gift to the son and the gift to the granddaughter. Is there anything there that would eat away at the nil rate band? Yes. And we're picking up this figure, the 139,000 figure. We're not taking 128, the amount of the nil rate band that actually got used for that pet when we were recalculating it. We're using the gross chargeable transfer value of 139. That's what you take away from the nil rate band when you're looking at the death estate. So that leaves us 186,000 nil rate band left, bringing the taxable amount of the estate down to 219,000. We tax it at the death tax rate of 40%, which gives us 87,600 tax due, same date, 30th of June 2024 for this one. So for your death estate, the tax is going to be due the earlier of 6 months after the end of the month of death, which is 30th of June 24, or it could be on delivery of the actual accounts to HMRC, if for some reason that was a different date. It's going to be the earlier of those two dates, but more commonly you're going to see just the 6 months after the end of month of death. So we have gone through the 3 different stages of the inheritance tax computation. We've looked at lifetime tax on lifetime transfers. We've then looked at what happens when the donor dies, and we have to go back and look at the 7 years leading up to their death and do death tax on lifetime transfers. And then we looked at the death tax on their actual death estate, the things they actually owned when they died, not the things they gave away during their lifetime. I really hope you found that useful to see the full cycle, and I hope that you find that you have more confidence now with your inheritance tax computations. If you've got any questions, please do drop them down in the comments underneath this video and I will get back to you with an answer as quickly as possible. And make sure that you hit like and subscribe as well